Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, Jonathan Wu back with the Finance Garage, and we are recording this on Friday the 27th of September on the back of quite a lot of interesting news out of China. So what we're going to try to do is break down a couple of things that has been announced over the course of this week. I guess these new stimulus measures have been a long time coming, is probably the best way to put it. China's effectively been in a stalling phase, a deflationary cycle for the better part of 2 years, and it's also been clearly hampered by the property market. So what I wanted to sort of unpack today is this effectively a potential turning point for the Chinese equity markets? As most of you know, we used to run a range of Asia and China equities funds, which has now gone across to Antipodes, of which I am an investment director for Antipodes for the Asia region. And so I thought today some of the things that I've written recently might be of interest to the broader investing community. And so we'll unpack that over the next 10 to 15 minutes. The aim, I guess, also with the Finance Garage, thanks for everyone who has tuned in to the first episode. We'll be releasing the second episode shortly, where I invited Tobias Bucks, who's the Ausbil Global Small Caps portfolio manager, in for a chat about the opportunity set, especially on the back of Mag 7 type valuations and the concerns that we see in that area. And so that will come out in the next week or so. So when we look back at the beginning of this week, the Chinese government on Tuesday unleashed a massive program of stimulus, which include cutting policy and mortgage rates, reducing banks' reserve requirement ratio to boost lending, and reduce the minimum down payment on second homes. Furthermore, there was another 800 billion RMB, or about 115 billion US dollars, that has been allocated to support the equity market following securities firms, mutual funds and insurance companies to pledge assets and receive funding from the PBOC or the People's Bank of China to invest in stocks. If we compare this against the backdrop of the policy setting we have seen in the last 2 to 3 years post the end of COVID, while in Australia we have rarely seen a lot of news being made about these Chinese stimulus programs, which ultimately have occurred, they've just effectively been more muted in nature, and I'll talk about why in a sec. But this one seems to be very, very comprehensive, right? Versus what we've seen in the last 3 years. Because this time is the first time in a long time we've actually seen meaningful stock market support from the government vis-a-vis the PBOC, and the scale of which is something that we haven't seen in a very long time. Now, the one caveat that I'll draw from what I'm about to talk about in terms of each of the individual line items of policies is that it does ultimately, at this point, lack meaningful fiscal support. Okay? Because at the end of the day, if you consider stimulus measures that is launched by any government around the world, the government can only do so much, right? Think of it as a simple tool like interest rates, where we have been talking about interest rate cuts in Australia for a while now. If the RBA cuts rates, it stimulates activity, right? Stimulates the public to pull more money out of deposits where they've been enjoying higher rates of interest, to go and to invest in other assets that will derive a higher return. It would encourage people to borrow more, to buy property. It will encourage businesses to borrow more money in order to expand their businesses. It's all very stimulatory in nature, right? So while the government and in Australia, the RBA has the power to decrease interest rates. At the end of the day, while that is the, let's call it the blunt instrument, the public needs to take up that slack or that slowdown in the economy, and they have to take it forward because the government can only use so much monetary and fiscal policy to bring the economy back to life. Okay, so on Thursday night or Wednesday or Thursday, President Xi Jinping himself came out and said, effectively he will launch a bazooka at this, and more than happy to keep firing on all cylinders to get the market moving again. So there is stuff that's in the background. I think that there is probably more stimulus to come, and we've seen the market absolutely rip really hard in the last week. We're seeing large cap companies going up 10 to 15% in a week, which is extraordinary, given the fact that valuations have been effectively been smashed for the last 4 years. Okay. If we look at the initial tranche of stimulus measures that have come out, first of all, they've done a 30 basis point cut or 0.3% cut to the 1 year medium term lending facility. So that gives you a rough idea of what's the general lending rate from 2.6 to 2.3%. We've also then had a 20 basis point cut or 0.2% of a cut to the 7-day reverse repo rate. So this is the effectively the rate at which banks interpose and lend money to each other, or your overnight rate, but this is the 7-day repo rate. We've then had a cut of the reserve requirement or the required reserve ratio or the RRR by 50 basis points. So what the RRR is in Australia, we call them Tier 1 capital ratios, which is what APRA, the prudential regulator that governs the banks, requires the banks to hold a certain amount of capital on their balance sheet and not lend it out to the market, right? In case we have an economic event that wipes out something in their balance sheet. It could be bad debts, recession that leads to forced selling of housing, so on and so forth. And these Tier 1 capital reserves effectively ensure the liquidity of the bank and the stability of the overall banking system. China calls this the RRR. The Chinese RRR rates are higher than our general Tier 1 cap ratios in Australia of 10%. And by cutting the RRR by 50 basis points or 0.5%, what that actually means is that it frees up the equivalent of about 142 billion US dollars worth of liquidity back into the system, which means the banks can then turn this around to then lend to companies, lend to developers, so on and so forth. Now, to the point I was making about a minute earlier was to say that this is the government policy that pushes the money and frees up the liquidity for the Chinese banks to then on-lend into the economy and the private sector. But people actually have to be willing to borrow, right? You can lead a horse to water, you can't make it drink. Okay, so this is the sort of caveat that I'll put to this. We've also seen, and this is something that was actually talked about 2 to 3 weeks ago, is that the PBOC and the Chinese central government have encouraged existing commercial banks to lower mortgage rates for existing loans and actually encourage mums and dads to refinance their loans into lower rates. We then have a further cut in the down payment ratio for second homes that has gone from 25 down to 15%, which means that you effectively need a lower deposit to get into the market to buy a second home. Because historically, since 2019, where the government first came out and said to everyone that you need to be focused on property being something to live in and not to speculate on, and people effectively ignored that policy standpoint. And since then, the market's just been ramping higher and higher and higher up until sort of late 21, when the government really put a firm stance down, and it leads us to today. But one of the ways that they effectively stopped people from buying second homes is to make the entry requirement, being the down payment ratio, so incredibly high that people couldn't afford to do it. Okay, so now that has come down. We then also have the PBOC directive allowing financial institutions to borrow for stock investments. Now, this is a sort of a double-edged sword, right? The government, and you have to remember President Xi's view of the world is that he does not like the endless money printing that we have seen in the US or Europe as a key measure of stimulus to inject in the economy. Okay. The key reason is you need to go back to 2009, where we saw the Chinese government firmly put down their foot and say, we're going to be what we call in Chinese, the train head, to bring the economy out of doom and gloom, out of the GFC. And they injected such a huge raft of bazooka level stimulus that they then had to spend the next 10 years actually unwinding. And this is the challenge, right? So if you're now at the PBOC level, allowing financial institutions to effectively issue debt into the market to borrow, to allow people and institutions to borrow money to invest more into the stock market, which will inevitably push the market higher, this is something to be very, very aware about. Okay? Furthermore, the PBOC has provided subsidised funds to be used for share buybacks and purchases by controlling shareholders. This is a 300 billion RMB facility, which equates to somewhere around 50 billion Australian dollars. Now, what's this about? This is part of the Value Up program that we've seen right across Asia that started in Japan around 2 years ago. We've seen the Japanese equities market rally. We've seen the Korean Value Up program, which is effectively regulators saying you need to increase your dividend payout ratios, you need to be more friendly to minority shareholders, and you also need to be considering higher levels of ROE. And ROC, or return on capital employed, and one of the ways you do that is effectively reducing your cash levels, because a lot of these in Korea we call them chaebols, or family controlled entities like Samsung and Hyundai. These are very rich companies, very commercially stable, but they don't provide a whole lot of returns to minority shareholders because they act like a family company, right, hoarding huge amounts of cash. So I bring down cash, using that cash to do share buybacks. China's sort of taking a page out of their book to do their version of Value Up. So what does this then mean for investors? And I think this is the key point for people to consider. Now, we've seen the market rally incredibly high. I think as at the point of this recording, the Hang Seng Index is sort of hitting close to 21,000 points, which is absolutely bananas in the context of how much we've seen it rally in 4 trading days. And if I sort of split it into 3 separate areas, this probably brings to life what is the reality that could occur, right, off the back of this stimulus, or at least this first wave, because we believe that there's probably going to be more to come. And this is me speaking as principal advisor here at the SWU Group, is that if we consider number 1, the property and the consumer sector, if we're reducing mortgage rates and the down payment ratios, this will hopefully increase housing market activity, transaction volume, and price. In the last 3 to 4 months, we've got empirical evidence to suggest that there has been an uptick in transaction volume and property volumes in China. So if we separate the conversation between transaction volume and transaction price, those are 2 very different things, right? You could have a lot of volume and a lot of transactions happening, but it might not reflect the prices are actually going up. Okay, prices could still be going down, your transaction volumes could still be going up. And this is sort of where we're sitting. But the fact that there is transaction volume, transactions have to occur before we see an uptick in prices, because if you have no transactions, or the volume is low, this reflects the fact that buyers and sellers are not meeting to actually transact, right? Which means there's literally no demand. If you have transaction volume and the prices are still falling, it means there is demand and people are trying to find cheap stock. The next turning point is to see price actually inflect, or at least find a bottom and then inflect. And that's going to be the real test in the pudding of whether or not this round of stimulus or series of stimulus will work. Because the next part of that is that if property prices inflect, then people will then have the confidence to consume, which has also been what's been lacking in the last couple of years because of the property crisis, coupled with lack of government stimulus in the form of bazooka, as well as COVID lockdowns. The second part of it, of what does it all mean, is the financial markets. So if we now have stock market support vis-a-vis PBOC facilities to borrow more, invest in the stock market, another facility to help companies do share buybacks, this could help stabilize markets and start to attract value orientated investors, which, as a practice, the SWU Group, we very much like value orientated type investing. It has been a lagging style, effectively trying to find attractive companies at attractive valuations, because you've got companies that are Mag 7 in the last couple of years, which are effectively growth stocks, shoot through the roof and sort of have left the value type investor behind. So in the short term, growth wins, but longer term, value does win. And it is good to maintain a balanced approach between those two types of investing. But value-orientated investors, especially when looking at the Chinese market today, value investors have been looking probably for the last 18 months, but there hasn't been much returns to show for it. The third part of what does it all mean is the corporate liquidity part, right? So this is referring back to the government dropping the required reserve ratio by 50 basis points, freeing up the $142 billion worth of liquidity in the system. This hopefully will encourage further lending by corporates to invest in other further growth assets or to expand their business for growth. Okay. Now, if we consider where the market then sits from a valuation basis, it's still very cheap after what we've seen this week. Okay? The historical average of Chinese equities has been around 9.5 times price to earnings, which is effectively the calculation of PE, meaning price divided by earnings. So if you divide the market cap of a company divided by its profits, that's where you get PE. And it's a very simplistic way. It's obviously not the only way to measure, but it's a simplistic way to measure whether or not a market is cheap or expensive. Whereas if you look at US equities, we're talking 15 plus, Australian equities 15 plus, so on and so forth, right? So there is further growth potential with these new measures, right? And if it's then coupled with improvements in consumption, housing activity, deflationary pressures, all this could help drive stock prices higher into 2025. And it's something that investors should be mindful of, because we've also seen that over years and over the long term, Chinese equities are actually quite lowly correlated to traditional exposures that we have in Australia, investing in things like Australian equities, as well as US equities and even European equities, right? So while the challenge is still there, it seems that the government has come to a point of reckoning where they need to end the deflationary spiral of the country. And this could help bring life back into the market. So I'll end today's podcast here. Hopefully everyone has a wonderful weekend ahead. And in the next week or so, you'll see our next episode with Tobias Bucks from Ausbil Global Small Caps. Thanks, everyone.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.